forward with him. Hiren, good morning. Fantastic to have you back. Let me throw some numbers at you because these are numbers which in a sense are telling you the market mood. Nykaa has a market cap of 1 lakh crore. That makes it a company which is more valuable than Britannia and Marico and Godrej Consumer. These three companies have cash flows, strong return on equity, and have growths of 15 to 20%. So what will change now? Will Nykaa come down, or will Britannia and Godrej and Marico go higher? Because somewhere markets have to meet.
So hi Nikunj, good morning. I think it's quite interesting, and it is creating a lot of dilemma amongst investors on how to look at companies. And I think that the difference is that we have seen some very high quality vertical companies so far in India. We are now seeing the birth of platform companies, right? And I think that what the platform companies have is the ability to acquire customers at a very rapid pace and reduce the friction. So traditionally, the Levers and the Maricos and the Godreges of the world took years and years to build out their distribution. Today on the online platform, your ability to acquire customers goes up very dramatically. However, what is important is that once you acquire the customer, how are you able to monetize that customer is going to be extremely important. And therefore, I think Nykaa has built a phenomenal business. The valuations can be questioned, but at least it's a profitable business and with real cash flows. And I think that there is space for both to coexist. Ultimately, the markets will decide what the right valuation is. So, after every few years, there is innovation, there is new entrepreneurs, there are new business models that come in, and you have to make space for them in the total market cap of the economy, of the stock market. And many of these platform companies will find a place. The only debate or the question is going to be at what valuations, right? So I think amongst all the new age companies that are going IPO, to my mind so far, the only company that I think has built a sustainable business which can generate sustainable cash flows is Nykaa. I think the rest is all still up in the air, in my opinion.
So do you think Nykaa could go the DMart way, which is that after a strong listing, DMart was also called as the expensive stock, but a 600 rupee stock in 2.5 years touched 5,000 rupees, little over 5,000 rupees. I'm not saying Nykaa will give that kind of a stellar return, but in terms of a trajectory, next 1 year, 2 year, 3 years, is the trajectory for Nykaa headed higher?
I certainly think so. I think that you're absolutely right that maybe we may not see the kind of returns that a DMart has given, because I think people took time to understand the DMart business model. But I think in the case of Nykaa, you will still get a steady compounding from here onwards. If investors have a 3 to 5 year view. But I must say that investors should be very, very careful. They need to have a very long-term horizon. But I think amongst, as I said, all the other businesses, probably Nykaa has built the best business. And over the next 3 to 5 years, I certainly see that the market cap will be much higher than what it is today.
Okay, so you're sounding a bull when it comes to Nykaa. The rest you feel is still up in the air. And so, Hiren, I'm going to just shift gears. The last time, we spoke with you exactly a month ago, you were talking about how this time round you will start to see a profit contribution from the mid caps and the small cap space. You once again started seeing the broader markets doing better. So if I could shift the conversation and ask you, is it as per your expectation? Because the valuations have really run up, then we started to see a sell-off too.
So I think, what I believe is that we have and as I've said before, we've exited the very narrow markets that we saw in 2018, 19 and pre-pandemic. I do believe that the breadth of the market is likely to improve here on. And in the next cycle, you will see a lot of sectors which will participate in this bull market than the very narrow markets that we saw in the prior years. And I think this rotation will keep happening between small and mid caps, and then they will correct and go sideways, and then the large caps will make a move. And that's how essentially a bull market matures. And I see this no different this time than any time in the past. But my feeling is that as the wise men say, you can't have direction and speed, rapid speed, both lasting for too long a time, right? So while we are confident of the direction, I think the speed of the bull market is likely to slow down a bit and consolidate. And I think it would be healthy. So I think intermittent corrections are healthy. And while the Nifty remained at elevated levels, in fact, in the last 2-3 months, many mid caps have corrected 20-25% from the top. And I think that's very, very healthy. So I continue to be bullish on the broader markets. And I think the breadth will continue to improve as we go along and as this bull market matures, but we are still in the very early stages of this bull market.
Okay, that's good to know that you're saying we're still at the early stage of the bull market. It's only the intensity of going up that may come down. Hiren, I watched the interview that we did with you exactly a month ago, where you were sounding quite bullish on specialty chemicals, commodities, and metals. Today, we're talking a day after the Nykaa IPO. Taking off from what Nikunj was saying, next week you'll have Paytm, you'll have Policy Bazaar. Look at the way Sumato is saying it's at an inflection point. How should one look at their portfolio? The value investors must be wondering, what are we doing? But how should one really look at all of this?
So I think, there is a lot of opportunities out there. I think right now, amidst the high decibel, media frenzy over the new IPOs, these are all cyclical things in the market, right? This will die down. And maybe when one or two IPOs fail, the enthusiasm, will wane. But I think that there are still a lot of opportunities in very high quality sectors and companies which are turning around. I mean, you look at some of the results of discretionary consumption companies. You look at some engineering companies. You look at, I think there is opportunities across the spectrum. But right now, I think everybody is so caught up in the new IPOs. And that is good for people like us because, we can silently go, where the crowd is not there and pick our stocks. And, there is enough money to be made in the high quality businesses that are not getting all the attention today. So I think that in terms of building a portfolio, I think that there is, in my mind, the clear leaders of this bull market. The leaders of the previous bull market was the private banks and NBFCs. The leader of this bull market is technology, undoubtedly. And I think technology will continue to lead, but there will be a lot of other sectors which will also participate. And we continue to be very bullish on specialty chemicals. But as I said, from here on, we will have to be very, very selective. I think the days of easy money making are over. I believe that, you will have to be very patient, pick your stocks. And I think it's going to be a great time for active managers because I think we will get in some time, and it's very difficult to time that, a situation where the Nifty does nothing for 6, 8, 9 months and just consolidates in a range, and valuations will normalize. But I think there is a lot of opportunity in the broader markets.
Hiren, so where are these hidden gems? Throw some light on that. You're accusing us of, putting the frenzy in the spotlight and only IPOs. We'll change that for you.
No, I think that I'm not accusing anybody. I'm just saying that what I see. I think there are opportunities. For example, I think that the entire consumer discretionary space, which got impacted by the lockdowns in 2020, is likely to do phenomenally well. And there are two trends that are playing out there, which is that there is massive consolidation that is happening in favor of some of the larger companies, the more formalized companies, and consumption is coming back. And what has happened was that the demand destruction last year was temporary, but the supply destruction was permanent. A lot of companies are out of business, and therefore, as demand comes back, this demand is going to be distributed amongst fewer players. So I think that, in my opinion, after tech, and as I said, we continue to be bullish on technology companies. I think it would be consumer discretionary, and I would specifically mention autos and auto ancillaries, because I think that these companies are currently facing headwinds because of chip shortage and supply chain issues, and the demand continues to be very robust, but the supply is lagging. Once supply catches up, you will see tremendous improvement in operating leverage and profitability. So whether it is frontline auto companies or auto ancillaries, engineering companies, small consumer goods companies, I think there is likely to be significant improvement that we see. We are also very bullish on the liquor companies. I think that there is an inflection point that these companies have reached, and I think discretionary consumption and premiumization is likely to accelerate into the future.
That's a very interesting point that you picked up on autos, and I was just thinking about that as well. What the market is busy focusing in on is the short-term hurdles like the semiconductor chip shortage and how it's impacting production. Time and time again, auto companies have come on platforms and said that they're looking at diversifying and increasing their EV portfolio. We saw that $1 billion funding coming in for Tata Motors, reports indicating that TVS Motors may be going the same way. And M&M in their interview to us as well, Hiren said that they're looking at, they're open to all channels of funding for their, EV expansion. You think EV is the way to go when it comes to autos, or would you be more restricted to the farm plays and ancillaries within?
No, I think EV is going to be a reality, very clearly. And there are, it is still early days, but obviously every OEM will have to move to EV because that's the future. But it's not going to happen overnight. And, I think there are certain companies who are very well positioned. For example, Tata Motors, as you know, have some very successful products in the EV range, which are out there. And, they are probably off to a very early start there. But not too far behind will be many other companies, whether it is M&M or the two-wheeler companies, who will also join the bandwagon. So I think EVs is going to be an interesting space, but these are early days. We believe that just the entire auto space, which, where demand is very, very strong, and I think most of these companies have been able to raise prices to ward off raw material inflation. I think that once commodity prices cool off, and which is what is beginning to happen, I think that if you look at the next 12, 24, 36 months, I see a very good cycle for automotive companies going forward from here. But here again, you will have to pick and choose the right winners. And I think ancillaries will also do well because, they will, they have the twin engines of both supplying to the domestic OEMs as well as exports. So I think we have exposure to both. And if you look at the results of, for example, Eicher Motors gave in Q2, I mean, it's fantastic. It's the highest ever per vehicle EBITDA that they have been able to deliver, despite the fact that volumes have not fully recovered, right? So whether you look at Tata Motors, whether you look at Eicher Motors and a clutch of ancillaries, I think we continue to remain reasonably bullish.
So let's take that point of auto ancillary forward. Manufacturing PLI is picking up. We know that Indian auto sector has an advantage both in terms of engineering skills and also cost advantage. Which is one auto ancillary name or auto ancillary company you think could be a pure bet on EV, which is that this company is in the right space, that if globally EVs pick up, this auto ancillary company will get a huge advantage.
So Nikunj, I think that, I think EV is still a very small portion of most of the ancillary companies, right? Incrementally, things will improve from there. I think the way we've played the EV theme is actually to bet on a few mid-cap software service companies, which actually are better levered to the whole EV theme, not just in India, but globally. So if you look at companies like Tata Elxsi or KPIT or LTTS, I think these companies are far better positioned to take advantage of not just the electrification of vehicles in India, but at a global scale. I think for the ancillaries, for them, the EV to be a large part of their revenue is going to take time. And it's going to be like any other component, right? Whether it's going into an EV or an ICE engine, it doesn't really matter. There obviously there will be some components which will no longer be required as we move to EV. But in our view, the best way to play the EV theme is to play it through some of the very, very great software companies like Elxsi and KPIT.
When you say you like consumer discretionary, are you mindful of the valuations for consumer discretionary stocks? Because consumer discretionary stocks, with the exception of auto, they are not cheap. Liquor stocks are expensive. Consumer durable companies are expensive. There is a raw material element which has been an irritant for an Voltas or an Havels. There is a spike in molasses and sugar prices which has been an irritant for Idico and United Spirits. How do you view that?
So Nikunj, I think that, you need to, again, within the discretionary is a very, very large space, right? And I think there are, as you rightly mentioned, I think within discretionary to us from a risk reward perspective, autos look very interesting. Liquor companies could look expensive, but I think the runway for growth is phenomenal. And I think that the bull market in liquor companies, in my opinion, is just about getting started in India. Right. So, there we have exposure to United Spirits. We continue to love that company. I think there are also some other areas like hotels, for example, or, there are opportunities in discretionary consumption where we still believe that the entire premiumization trend is yet to completely play out. Right. And for example, luggage companies or hotel companies, stocks. I think these companies have not yet delivered to the full potential once the complete opening up and travel opens up. Now, airlines is not where we would invest in, but they will also benefit because of the opening up. But there are restaurant chains, right? There is hotels. There is liquor companies, right? And there is a lot of opportunities in the discretionary consumption space where things are just about opening up. And I wouldn't go by current valuations in these companies because the profitability has not yet reached normalized levels, right? And I think that these optically high valuations will seem reasonable over the next 2-3 years as the top line starts to recover post-pandemic and the margins are already at very healthy levels. So I think once the top line recovers, you will start to see very strong earnings growth over the next few years. So I think there are pockets within consumer discretionary that we like, and not just, generically speaking. There may be a lot of areas where valuations are very rich, more in the staples and some of the areas that you mentioned where stocks have already rebounded very strongly, and the markets are already pricing in a solid earnings recovery there.
Hiren, what essentially is your sense on this entire asset allocation shift, which is now clearly visible? The SIP portfolio is almost at 10,000 crore. It was like a far-fetched dream, let's say 3 years ago, $1 billion, $1.5 billion of SIP, which is now consistent. If I look at the PMS schemes, all of them are happily sharing with us that fresh inflows have started. Do you think this trend of asset allocation change at HNI level, at ultra HNI level, is here, and do you see that increasing?
Absolutely. I think that, there were two inflection points which got a large part of India starting to invest back in equities. One was demonetization. That was the first inflection point. And COVID was the second inflection point where people realized that, that equities is a very superior asset class, given the fact that, the alternatives are not so great. So I think that there is a structural shift, and we are just about getting started. Even today, despite the fact that we have so many new demat accounts that have opened up, I think these new IPOs will also bring a whole lot of new investors into the market. I believe that this trend is only likely to accelerate going forward. And today we don't really, it doesn't really matter whether FIs are buying or selling, right? I mean, I think domestic institutions and domestic retail participation in equities is strong enough to absorb any FI selling. So I think we've come a long way. We used to shudder earlier when you had a big negative FI number of selling, and 10 to $15 billion would move markets one way or the other. I think today they are just one of the players in the market, and they don't determine the direction of the market. I think domestic money is now mature enough, strong enough, and the flows will only accelerate, to my mind. So I think we have something great going on here, and I think this trend will only accelerate. And I think with the advent of the new age fintech online brokers, more and more younger demographic investors are coming into the market, which is good because they start at an early age, and therefore they are likely to stay in the markets much longer. So I think it's a great trend, and it portends very well for continued and sustained equity flows into the markets.
We're going to leave it at that. Thank you so much for joining us today live on this edition of The Market. Look forward to having you back soon.
Thank you so much.